Hello and welcome. In today's session, we'll explore central banks and their policy statements, and how these influence the economy. We'll cover key tools like interest rates, quantitative easing and tightening, and examples from major central banks such as the Federal Reserve, ECB, BOE, and BOJ. Central banks manage a country's money supply, interest rates, and overall economic stability. Traders closely follow central bank statements to anticipate shifts in monetary policy. Some key examples include the Federal Reserve in the US, the European Central Bank in the Eurozone, the Bank of England in the UK, and the Bank of Japan. Central banks have several crucial roles. They regulate money supply and credit conditions, control inflation, stabilize prices, influence employment and economic growth, and act as a lender of last resort to banks. Understanding these roles helps traders interpret the meaning behind policy statements. Central banks use a variety of tools to manage the economy. First, interest rates, which influence borrowing and spending. Second, open market operations, where the bank buys or sells government securities. Third, reserve requirements, which set the minimum reserves banks must hold. Fourth, quantitative easing, QE, which increases money supply to stimulate growth. Finally, quantitative tightening, QT, which reduces money supply by selling assets or letting them mature to control inflation. Policy statements are released after central bank meetings, such as the FOMC in the US or ECB press releases. They guide markets on the bank's future monetary policy direction. Common elements include interest rate decisions, economic forecasts, and inflation targets. Traders study these statements carefully for clues about upcoming market conditions. Some examples of central bank statements include the Federal Reserve's FOMC statements, which announce key interest rate changes and economic outlook. The European Central Bank's statements, providing guidance for Eurozone monetary policy and inflation expectations. The Bank of England statements, covering UK interest rates, inflation, and employment. And the Bank of Japan, which discusses policy rates and yield curve control measures. Traders use policy statements to forecast interest rate changes, anticipate currency movements, and adjust trading strategies across stocks, bonds, forex, and commodities. Being able to interpret these statements is essential for making informed trading decisions. Central banks regulate economic stability through monetary policy. Policy statements provide critical insights into the bank's view on the economy. Understanding these statements allows traders to anticipate changes and make better informed decisions in financial markets. For further reading and up-to-date information, refer to sources like the IMF, the Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan. That concludes our session on central banks and policy statements. Thank you for joining.